there is the very boring meeting of the Fed. In to make it interesting this morning, our economist on call from Emirates NBD, MENA Economist Dan Richards. Dan, good morning.
Hi, good morning.
That is your challenge this morning. Right, let's start with what actually happened. As widely expected, the Fed did nothing. Why did they do nothing?
Yeah, so perhaps not that exciting to start with. The decision was to keep rates on hold, 3.75% for the upper bound. That had been widely expected. As you say, it was pretty much zero pricing in of a cut yesterday. Everyone had expected it, so pretty much foregone conclusion. There was a bit of dissent in the voting, so it was 10-2, but again, that was probably expected. If you're going to say who's going to dissent, you'd probably pick the two people that did dissent. So all in all, pretty much as expected, so everything was all about the commentary, which perhaps was a bit more hawkish than had been previously. The economy seems to be in a good shape, was essentially what Jerome Powell was saying, and there doesn't seem to be any signal that a rate cut is coming imminently.
Yeah, what did he say? Economy growing at a solid pace, unemployment rate vaguely stable, inflation somewhat escalated. It's his job to be dull. Let's be fair. His job is not to scare the horses. But we didn't really get any guidance in terms of where they were going forward, apart from we're going to watch the data.
Yeah, which isn't particularly exciting. I think the takeaway is that the pricing now is that there's not going to be a cut until essentially the July meeting, when one cut is now fully priced in. So essentially, given that Jerome Powell's term is set to end in May, that means that he aren't going to be any more rate cuts under his tenure, which perhaps isn't that surprising, given he has been relatively resistant to political pressures around that. He has been all the time saying, of course, we're going to be data dependent, all the rest. And when you look at the data, there's a case to be made for it. Inflation, it's still around 2.7, 2.8%. While the labour market it is looking soft, but he's saying it's improving, and it's not really screaming out for support.
What we all did turn up to hear, though, let's be honest, with the popcorn, was whether or not we would see him push back on that Department of Justice criminal investigation. But even then, despite the unprecedented video that we saw released at the start of this month, not a lot of chat.
No, well, like you say, it's his job to be boring. He's a consummate professional. He is a central banker to his bone, and he kept it around the data as far as he could. Now, clearly, there's always going to be questions around the circus in the press conference, but he addressed that as directly and quickly and swiftly as he could, I think, without making it pertain necessarily to what was going on in terms of their rate decisions, which is how it should be. There shouldn't be, in normal circumstances, under normal administration, such a political noise around what is going on at the Fed, I think.
Yeah, I've even opened Truth Social because there's one man who wanted those rate cuts who didn't get them, to see whether we've got any pushback from the President of the United States, apart from retruthing a story about the Fed not yet complying with subpoenas. That has been it so far. So a muted day all around. Two questions for you. What's it going to take for the Fed to start cutting rates again? And what does that and all of this mean for the UAE?
So for the Fed to start cutting rates again, I think we need to see a bit more of a material impact on the labour market, certainly. So the last NFP, labour market data has been coming in steadily softer. The last NFP, as for non-farm payrolls report, is kind of the big labour market indicator that we watch out for. 50,000 last print, not particularly strong, but again, it's not a decline in jobs, right? Jobs are still being created, and Jerome Powell was saying that Q4 was so strong, the economy is so strong. We just had some pretty solid tech results coming in, that the expectation would be that would improve even from here. So for it to go the other way, we'd expect to see a pretty sharp drop off in the labour market, and also a more material slowdown in inflation. What's that mean for here? Well, lower interest rates can be a positive for local economy here. But certainly, anyone with a mortgage would appreciate it. Businesses with lower cost of capital would appreciate it. But it's not been the key differentiator here over the past several years. Growth here has been strong, even through that period of higher monetary policy, tighter monetary policy we've had over the past several years.
We have had the US president say that he doesn't mind the weaker US dollar, which is unusual. Presidents don't usually comment on the currency apart from to say that they like a strong one. The weaker dollar for us,
Yeah, so there was a bit of a pushback yesterday, I think, from Scott Bessent saying they hadn't changed policy on that, but certainly the dollar has weakened. What's it mean for us? Well, for imported inflation, that does run the challenge that some imports are going to be more expensive. Certainly going on holiday to some destinations would be more expensive. But equally, when you look at the dollar against some other key regional economies, whether it's the rupee or the lira or some other countries we might import from, it hasn't sold off like it has against the euro, for instance. So that isn't going to be as forceful an inflationary impact as you might expect.
Thank you so much for coming in and joining us this morning. Dan Richards, MENA Economist at Emirates NBD. Make the Fed boring again, as it should be. We appreciate your time this morning.
Pleasure.